Hi guys, welcome back to another video. Today we're going to be talking about the 2022 recession, why and how it will happen. So if you don't recall, the last 2 days we had some major news. We had the FOMC hearing on May 3rd and May 4th. What happened here was that the Feds actually raised interest rates by 0.5%, right? And we can see here that this is the largest move since 2000. So I'm not in total agreement that interest rate hikes can go super high because the US government would have not be able to afford the interest rate payment on their $30 trillion national debt. And this is soon to be 100 trillion because of their printing of money. They can't afford to pay back the central banks, and that's why they are not able to raise it that high. And if they want to bring down inflation, but bringing it down too fast would cause them to be insolvent, and that will also cause the economic collapse, which is something they want to totally avoid, right? So if you've not been following the financial news these last 2 years, you can stay up to date on my Telegram channel. I give market updates and I give all this for free. I also did recall that I also mentioned that this 50 basis point hike was already priced in. That is why our market actually corrected the last couple of months. But are we still going to correct? I think yes. So I'm going to give you a rundown on what happened in the last year if you're new to investing and whatnot, right? So what we saw in the last year was that due to COVID, we saw everything crash, right? Our Nasdaq, our S&P, our crypto, almost all asset classes found a bottom on March 2020. So Nasdaq fell to 6.8k from 9.8k, and after that, it all went up as well. So S&P fell to 2.1 from about 3.4, and after that, it went to 4.7. Likewise, for crypto, we found a bottom at 3,000. And we all did the whole run up all the way to 65 to 69,000. So why did we have this bull run, right? You might be questioning. Well, we did have this bull run because of the Fed's printing money. If you don't know already, 80% of US dollars in circulation has been printed out in the last 1 to 2 years, which means that they have been giving out stimulus checks, they have been injecting money into the economy to artificially prop up this economy. So what I can see from this is that it's a bit of a false run-up. It's a assets run-up. That doesn't mean that we cannot make money from it. But understanding the market conditions now, you have to realize that interest rates are going to be creeping up in the next couple of hearings, right? And they can't keep doing this back and forth, keeping it within this range for much longer because inflation, believe it or not, or like it or not, is here to stay. It is not transitory, right? We can see it from our goods and services getting more expensive all across the world. Right, so I'm going to talk about why this run-up happened also. It also happened because the US was also buying back bonds, right? So by buying back corporate bonds, they were able to give this bailout. And this bailout expectation then caused the largest corporate borrowing spree on record. It improved investor confidence. Everything went up. And, you know, where does this leave us now, right? So I've long been saying that a severe market correction is due. And we all know that market corrections happen every 9 to 12 years. But given the difference in instruments these days and difference in policies, and there's so much new, the monetary system is different, it is now than in the past. So we can't peg it to a 9 to 12 year cycle. And different asset classes also have different cycles. If you talk about crypto, it's actually 1 to 2 years maybe. We see a big crash and a big run up. So I do believe that we are due for a crash, correct? Or a large correction, but we need some sort of a push, like an impetus, and I think we're seeing that right now, right? So why do we see a crash or impetus correction, right? Well, if you learn in, like I mentioned about the circular flow of income, there is this thing called a multiplier effect when it runs up, and likewise when it goes down, there's a reverse multiplier effect, like the reverse wealth effect. I'm gonna go and let you see some of the material here. So what is a reverse wealth effect? A reverse wealth effect is when an increase, so a wealth effect is an increase in the real or perceived value of one's assets, right? And then that gives them a lot of confidence in the market because they have a lot of paper valuations. In the COVID period, in the pandemic period, a lot of people had they started buying stocks. There was a lot of a gamification of the investing, right? So gamification of trading. We had a Robinhood, we had so many new trading platforms that come out and people injecting money into the economy, right? And this whole run up made people believe that they made a lot of money. But as the market reverses, what happens? Investors start losing confidence, they start pulling out, and with the onset of inflation, when goods and services are higher and they start having to spend money again, they will start realizing that they need to take out cash. And the more they take out, the more it drops, the more fear there is in the market, and that causes a downward spiral. Aside from that, right, the reason why this impetus is also created is because of the velocity of money, right? So during COVID, we didn't really travel much. We were staying at home. We kept everything in our savings. We kept everything in our stocks and assets. Everything went up. We felt happy. But once people started traveling again, they need to start doing business expenses again. Businesses start opening up. They start spending money again. They need to take money out of the assets. And as one by one, more people start taking money out of their assets, right, and their stocks, this causes a liquidation cascade. What is a liquidation cascade? It's when something just keeps falling and falling and falling, and people who previously borrowed during COVID, like they margin borrowed or they margin buy. So buying on margin means that they buy their stock using borrowed capital. But since they are not able to pay off this margin, they start cashing out. And then more people see their portfolio dropping on margin and on leverage, and they start pulling out. And as more and more people start pulling out, we will see a further drop, right? And this is coupled with travel resuming, velocity of money increasing, onset of increasing pressure from inflation, a bearish market, and hawkish policies, right? So right now, we are seeing this kind of effect take place. So of course, it's not to say that we're entering into a Great Depression. We are not in the same scenario where we were in the 1930s, nor in the 1979s with the Asian financial crisis, nor are we in the same situation in the Lehman Brothers or the subprime mortgage crisis. It's an entirely different situation that we're in right now, right? And we are in an age of abundance and a lot of urbanization. So while the financial system may be manipulated and some sort ruined, I don't believe we will sustain a prolonged period with financial collapse like in the past. We won't have a prolonged. Cycles are getting shorter, right? Recovery will also get shorter. And money flows are picking up, right? So I think that if anything, the only risk is that US loses some of its strength as the reserve currency of the world. It will not hold its status as a global powerhouse. We might not see US dollar as strong now as in the past. And obviously it will depreciate against other currencies. And other growing economies might not take its place, but take some of that market share. Right? So overall, as we get through COVID and eventually when production picks up, the economy picks up, employment picks up, I think the economy will slowly be bolstered and recovered. So what I'm trying to say here that if we do get a dip, and I think we do, this is a dip worth buying. But timing the dip is especially important because if you really want to make money, you have to buy at the bottom. So when do we buy, right? We buy when the interest rates are done, when they have sustainably fought inflation, and that will come when after I presume that will come at Q3 or Q4 this year, and I don't think that we'll see a good run up this year at all. Actually, I think that we are already seeing the signs of a breakdown and a reversal, and I don't think that we are in a bull market anymore. That's my opinion. Anyway, if you want to check out more of my learning material, do check out my website. I also do leave some stuff in my Telegram market updates below. And as always, remember to like, share, and subscribe. I'm going to try to do more of these stuff with you guys. If you agree with me, drop a like. If you don't agree with me, dislike, I don't know, drop some comments, give me your opinions. I would like to hear from you. Thanks for watching. Bye.